I want to wish everybody watching this channel an extremely healthy, prosperous, and successful new year. 2022 has obviously been an extremely difficult year, to say the least, as an investor, but it has been the best year for my very small channel, and I appreciate every single one of you that like, subscribe, and watch my videos, because obviously being a small YouTuber in this space is not a very easy job, given the amount of criticism you get, and obviously being a very difficult year in the market itself. But because of the fact I have lost a lot of money on paper this year, I have learned a lot of important lessons, both for specific stocks and also general investing strategies that I've applied in 2022 that I could have polished up a lot more. And as a result, I want to share those in this video, as well as how I'm repositioning myself and my psychology for 2023, even though we expect 2023 to not be any better than 2022, given the way the stock market is behaving today. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. So to start things off, let's understand where we've come here in 2022. What has been the biggest headline lesson as an investor? For me, it's been the fact that growth stocks are extremely risky in a time of high inflation and high interest rates. I think that goes without saying, but 2022 has been up there with one of the worst declines in the post-World War II era of the S&P 500. If you look at the chart itself, it doesn't look too bad compared to 2000, 1973, or 2007, but given the fact that we're not really going through an economic crisis here in the US, and the fact that this was primarily all driven by a bubble popping, interest rates going up, and inflation being very high, this is a pretty significant decline. And let's be honest, the S&P 500 does not do justice to the declines, because the Nasdaq is down more than 10% than the S&P 500, and something like the ARK investment funds are down over 80% in 2022. So as an investor in the growth stock market, which is typically what most retail investors ended up doing, it's been an extremely difficult year. And obviously that started all the way back in early 2021, which is when inflation started going up significantly. We got the February CPI report, and that's when the tables really started to turn, in my opinion. The overall market didn't start collapsing until the end of 2021, but in the start of 2021 is when you knew something bad was coming. And that was not better evident on anything other than the ARK Innovation ETF. As you can see, this growth ETF peaked in the February of 2021, when the overall S&P 500 actually rallied over 20% for the rest of the year. This was a sign that something bad was about to happen for most growth equities. The market was already starting to price in the fact that interest rates were going to go up aggressively because inflation had basically gone out of control. Inflation continued to rise throughout 2021, and that is what led to valuations continuing to compress in any stock you bought, because obviously that resulted in the 10-year yield, which is the interest rate for the long term, to go up. And as that goes up, valuations compress, and that is obviously something completely out of your control as an investor. The only thing that you could have done, and that I could have done in 2021, was be more selective with the companies I bought, meaning not buying companies that had a very excessively high price to sales ratio. That really is, to be honest, the biggest lesson of 2022. Company valuations are extremely dependent on long-term interest rates. Here you can see, as the 10-year yield in the US started climbing in the middle of 2021, that's when the S&P 500's PE ratio started collapsing. And you know that if the S&P 500, which hosts the biggest companies in America, is going down, then small cap unprofitable growth companies, which is what I primarily invested in throughout 2022, would suffer on a greater magnitude. And that is exactly what happened. Regardless of buying the dip or good fundamental news about your companies, stocks continue to go down. And that is important to understand in this kind of environment. Regardless of the fundamentals, the market is driven by panic and sentiment in the short term. That is literally what moves stock prices. Stock prices are not driven by the actual fundamentals, the cash the company has, the net income, the profits. It's driven by what the market thinks about that company. And when interest rates are going up, the market thinks that most unprofitable companies are just going to go bankrupt. It does not do any research on those companies like we're doing on this channel. It instead just focuses on the next 12 months, looks at their balance sheet and says, hey, this company is probably not going to survive, so I'm not going to buy this company. I'm going to short this company as a hedge to the overall declining market. And obviously, growth stocks were the ones to peak first in the Feb of 2021 before the rest of the market. And luckily, that is something we should expect to happen in the opposite when the bull market starts, which is that growth stocks should bottom first and the overall market will start to recover. And that neatly brings us on to lesson number 2, which for me is don't concentrate too much into one sector, regardless of how much conviction you have in that sector. Now, you guys know I talk a lot about electric vehicles and hydrogen on my channel because that's where my expertise from an engineering and career perspective actually is. And as a result, I've concentrated most of my portfolio in that space. You can see the main companies I own in my energy growth portfolio are in the hydrogen and EV space. And although this is great for me because I'm diversifying in one sector, it's important to understand you want to actually diversify in different sectors if you don't want extremely poor returns in the market. Now, for me, I'm completely fine getting this negative 56% return for the year because obviously I did not go too high on margin and I left always a good amount of cash on the sidelines to make sure I have a buffer. But obviously it still stings, and it's important to understand how I could have improved this return, especially if I was a hedge fund and I was trying to prove to somebody that I was a good investor. And I think the best way I could have done that was by making sure that I don't own only EV and hydrogen stocks, and maybe I own other companies in the energy space like oil and gas, refineries, and consumer discretionaries, which ended up performing a little bit better in 2022. And obviously that was because in 2022, even though most tech stocks suffered, oil and energy performed extremely well. Some sectors of the 11 sectors of the S&P 500 didn't actually perform that poorly. Energy was up 59% in 2022, and utilities were down only 1.4%, followed by consumer staples down only 3.2%. This shows you that it is possible to have a good year even though the overall market has a bad year. And for me, unfortunately, I got caught up investing in these sectors down here, which as you can see were down over 28%, 40%, 37% for the year. And so it's important to understand how you can pivot early on so that you move and diversify your portfolio into these sectors early on in the year, not way too late, which at that time, the investment thesis is just broken. And obviously, since my portfolio is focused around small cap companies that are unprofitable, the main indices that I focus on are the XBI Biotech ETF and the iShares Russell 2000 ETF here in blue and dark blue. And as you can see, they performed abysmally in 2022. So I could have done really well by diversifying my portfolio into less riskier assets, even though my conviction in these risky assets that I invest in continue to go up. But obviously that's one of the biggest lessons, which is that don't just follow your conviction if you want to get good returns in the short term. In the short term, because the bear market is so unpredictable in terms of length, you want to make sure you diversify into other sectors, whether that be buying individual stocks or buying ETFs, like I could have just done with the S&P 500. Because guess what? Each one of these sectors has its own ETF that is controlled by the SPDR Corporation. Just like the S&P 500 is tracked by the SPY ticker, each one of these has their own ETFs. That is something I've been slowly starting to add in my retirement accounts, which is where I only invest in index tracking ETFs or sector tracking ETFs. And finally, for me, lesson number 3 would be the fact that stay away from more riskier companies when inflation is starting to go out of hand or when the M2 money supply has expanded too much. These warning signs were available in 2021. I did not personally know how a market performs when high inflation happens because obviously I was not around investing in 1974. But I could have now in hindsight learned that when inflation goes up and M2 money supply goes up, interest rates are expected to probably go up at an extremely fast pace. And what happens when M2 money supply expands is people have a lot of money to spend and euphoria in the market starts to get out of hand. And actually, we saw that really clearly happen with what happened with GameStop and AMC back in early 2021. I'll be honest, there could not have been a better predictor of the market top than what happened with GameStop in January of 2021. You guys remember when this happened, the market was going absolutely insane. Every stock that had some sort of short interest or was unprofitable and a small cap was going up every single day. It was extremely easy to make money in that market. Anybody who had a brokerage account would make money. And as a result, people got extremely attached to stocks like GameStop who believed that the market could never go down. The market is only going to go up from here. There is no way you can lose money in the market, and that anybody could do it even if you have no experience. But clearly that was the wrong take. And as a matter of fact, it's in February of 2021, just about a month later after this happened, that the overall market started to peak and inflation went crazy. You could call this a result of the stimulus checks that were handed out at that time, or a result of the overall euphoria that was building up in 2020. But in hindsight, it's clear as day that that was a big sign of the market topping in the short term. When there's so much undeniable euphoria in the market like we saw in 2020 and 21, you know that we're near the top. If you go back to any YouTube channel back then, every single YouTube channel talking about the stock market was going crazy. People were making records amount of money on Twitter, Instagram, giving financial advice left, right, and center that happened to work in the short term because every single stock was going up. But obviously that turned out to be the big problem for 2022. And as a result, we've been paying the price in that in the form of the S&P 500, crypto, and emerging markets absolutely collapsing. Even Tesla, for example, can be considered one of these big cult followed stocks of 2021. The stock went up significantly, the fundamentals were doing great, but now it's coming down even if 2022 was the record year for the fundamentals of the company. And that's all because the market does not care about fundamentals, it cares about sentiment. And as a result, it's also important to understand when you should sell stocks, not only when you should buy stocks. And that's also a big lesson for me. And to be completely transparent with you guys, the main stocks that I took realized losses on in 2022 were Corsair Gaming and a company by the name of Romeo Power. RMO was the ticker symbol for that stock, and that stock actually got bought out by Nikola Motors, which obviously is one of my biggest investments right now and one of the stocks that I'm most adamant about on my channel, and for good reason, because that company is misunderstood. But obviously in the short term, it turns out the stock does not care about those fundamentals, and the market just cares about profitability. They care about cash burn, profitability, not really any form of growth. And so when the market starts to bottom and when the growth starts to set in, that's when we should see those types of investments relaxing. And unfortunately, that's not happening anytime soon because we have this impending recession coming up in 2023. And it's difficult to know how investors are going to react to that. But despite that, I also have had some winners in 2022 that I took profits on, particularly a stock by the name of Arlo Technologies, which I ended up selling right near the peak of the market. Nothing to do with my timing or my strategy, just complete luck, where I ended up selling it around here at the end of 2021 and the start of 2022. And the other stock was Zynga, which actually got bought out and is no longer a ticker, but it got bought out by Activision Technologies back in the early 2022 and made a pretty hefty profit on that. But apart from those moves, I haven't actually made any other moves when it comes to specific stocks in 2022. I've been buying the dip, dollar cost averaging, investing in my companies on companies that I haven't lost conviction on. Now, we have yet to see if, I might lose conviction on them in 2023. And if I do, that's unfortunate. I will take my loss and move on. But I hope the lessons I discussed in this video really help you guys because, let's be honest, 2022 has been an anomaly of a year. I know it's difficult. And although back-to-back down years are rare, they can't happen. So it's important for you to understand how you can position for 2023. But obviously, guys, that is just my opinion, so let me know your thoughts down in the comments section below. I'll be continuing to pump out YouTube videos in 2023, sharing the latest research about the investments that I am most passionate about, and I hope I can teach you some good lessons on how you can become a better investor for the next time a year like 2022 shows up.